Welcome to Satya Skills. In this video, let us learn about impact of reforms on banking sector in India. Banking sector reforms brought tremendous change in the attitude of banks towards their operations and functions. It showed multifarious effect on the financial system and also on the banking habits of general public. The following are the results of reforms. The first one is deregulation of interest rates on all types of loans and deposit accounts made the banks to depend on market forces. What are the market forces? Demand and supply. To attract customers, banks are offering value added services in this regard. Second one, banks are permitted to improve the capital base through public issue. This activated slow and calm Indian capital market, including the primary and secondary markets. Banks are insisted to adopt prudential norms for income recognition, asset classification and provisions, etc. This decision alerted the banks to concentrate on the reduction of NPA. Now, all public sector banks are very careful in choosing borrowers and taking care in loan collection process. Next one, after reforms, banks adopted uniform accounting practices and investment valuation methods. This facilitated easy comparison between banks. After reforms, RBI is able to obtain reports on quantifiable parameters such as quality of deposits, loans, income generating investments, improvement in internal productivity, operational efficiency of banks, etc. Another one, with the entry of new private banks and also foreign banks, the public sector banks are forced to improve the quality of services and concentrate on neglected concept of customer satisfaction. Banks are improving the physical appearance of front offices and are introducing package of suitable services to the customers. This is to just attract more customers. Reduction in CRR and SLR facilitated banks to expand, diversify business to new areas. Now, more funds are flowing into the banks to invest in more profitable activities and income generating assets. Now, banks are giving true picture of their financial position through balance sheet. The government of India concentrated on weak banks and provided some capital to improve the capital adequacy. Now, banks are earning and showing true profits. Banks are free to fix their own exchange rates. Banks are free to open and close branches. This reduces the number of loss-making branches and consequently the burden of unnecessary expenditure on banks. It is reduced. Banks also encouraged voluntary retirement scheme to reduce number of employees. Banking Ombudsman scheme was improved to provide quick settlement to the customers' grievances. Sellers markets became buyers market in Indian banking. Employees are given good training programs to improve their skills. Example, all staff are trained in computer languages. Within a short span of 5 to 8 years, banks are able to get computerized complete 100%. Today in small towns also one can find ATMs. Online banking facilities are introduced on a large scale. Now everyone is availing that facility. The passive nature of employees is reduced to large extent. They are involved in improvement of banking programs. Now, emphasis of banking sector is more on income generation and building viable profitable system without adding burden to the customer. Productivity at every stage became the key word of Indian banking. Measure of efficiency in banks shifted from deposit mobilization to productivity, branch expansion to reduction of non-performing assets. These two are very important points. That's all in this video. All the best.